Imagine walking into a car dealership. You pay the full price, but the dealer tells you, you might drive away in a luxury sedan or a broken bicycle. We'll decide with a coin toss tomorrow. You would call this absurd. You would call it a scam. Yet in the trillion-dollar world of global derivatives, insurance, and high-frequency trading, this exact coin toss is hidden behind 50-page legal contracts, complex formulas, and layers of financial jargon. In the world of Islamic finance, we have a term for this destructive force, Gharar, excessive uncertainty. It is the hidden trap that separates stable economies from systemic collapses. Today we'll uncover how Gharar works, why it matters, and how Islamic finance solves it. Welcome to EQTSAD Global, your global Islamic economy hub. To understand the engine of Islamic finance, we first need to see what causes financial systems to fail. Gharar literally means uncertainty or ambiguity in a transaction. Its Arabic root implies deception, hazard, or putting oneself in danger. Classical Islamic law prohibits transactions where the existence, ownership, or delivery of the asset is uncertain. In modern terms, you are selling a probability, not a product. Islamic jurists categorize Gharar as Gharar Yasir, minor. Small uncertainties unavoidable in trade, forgiven. Gharar Fahish, substantial. Major uncertainties affecting price, delivery, or asset, which make a contract void, battle. Economic logic, why Gharar matters for stability. Some critics ask, isn't all business risky? Why single out Gharar? Islamic finance distinguishes between commercial risk, gunm. Healthy encourages innovation and effort. Example, opening a store without knowing the exact number of customers. Pure uncertainty, Gharar, risk arising from information asymmetry, ambiguity in price or delivery. Example, betting on subprime mortgage bundles without knowing the underlying assets. Excessive Gharar creates zero-sum outcomes. If one party wins, another loses. Economies dominated by Gharar encourage speculation, not productive activity. Think back to the 2008 financial crisis. Credit default swaps, CDS, and subprime mortgages were Gharar-heavy instruments. These bets on bets, wrapped in layers of opacity, destroyed trillions in imaginary wealth. Investors and banks often did not even understand the risk they were taking. Modern applications, 2026 context. Gharar is not just history, it's alive today. Crypto and binary options, short-term price bets without owning the underlying asset. Pure Gharar disguised as trading, often akin to gambling. Insurance. Conventional insurance involves uncertainty in both payout and premium. Islamic finance solves this with takaful, a mutual cooperation model where participants share risk and rewards transparently. Derivatives and structured products. Many modern derivatives rely on probabilities rather than tangible assets. This creates opacity and systemic risk, exactly the type Gharar warns against. Accounting and Auditing Organization for Islamic Financial Institution Standards, professional benchmark, for academics, practitioners, and institutional investors. Standard number 31 provides a clear filter for identifying Gharar. Its categories ensure the Islamic Finance Engine remains tied to real economic activity, tangible assets, real services, and clear obligations. This is the principle that keeps Islamic finance resilient even in global crises. Practical takeaways, why you should care. Avoid contracts where price, delivery, or asset existence is uncertain. Recognize that many financial innovations today, CDS, certain crypto derivatives, or complex insurance products, may fall into Gharar-heavy territory. Islamic finance offers a tested framework for ethical, stable, and productive economic activity. Conclusion. The prohibition of Gharar isn't about restricting freedom. It's about clarity, fairness, and stability. In a world flooded with debt, speculation, and digital illusions, Islamic finance provides a blueprint for certainty. You know what you own. You know what you owe. You know the risk you are taking. Ask yourself, is your next investment a step toward building real value or a leap into a hidden trap?